Welcome to topic 5 of the income statement, part 4. So in the part 4 video, what we're going to be doing is preparing an income statement and also providing you with some basic interpretations on these income statements. So now, from the following list of items, prepare an income statement for the year ended 30 June 2013. First of all, we need to classify the accounts into asset, liability, owner's equity, revenue or expense. Now, only revenues and expenses go into the income statement. So what this exercise is going to do, it's also going to pull on some of your prior topics knowledge to see if you can still classify things too. So you've really got to make sure you're on top of your ability to be able to classify accounts, because it's only you build on it with each topic that we pass through. So if you're struggling with it, please do some extra revision and some extra practicing to make sure you can do it comfortably. So starting off with cash. So cash, as we know, is one of our assets. It's our most current asset because it's very liquid. Sales. So sales, what we're generating from, say, providing our services or selling our goods. So sales, form of revenue. So we'll classify that as a revenue item. Salaries and wages expense. So one of the nice things with a lot of our expenses is that they give themselves away. So we can say we have an expense account here. Accounts receivable. So we know from previous videos that anything with the word receivable in it, it's an asset to us. So it's an item of value. So it's a current asset because it's also that shorter term asset as well. So it'll convert to cash within that 12-month period. Now we have loan interest expense. So another one, the expense or the word expense in the name, it's more or less giving itself away. So classify as an expense. The loan payable, so pay in payable indicates we've got to pay, we owe someone. So loans as well are generally longer term liabilities as well, unless you're explicitly told that it's a short term loan. You would assume that generally loans are going to run for more than 12 months. So we're looking at a non-current liability here. Insurance expense, so again, expense, it's in the name, it's giving itself away. So expense. Cost of sales. So cost of sales relates to inventory. So as a retail firm, we have inventory, and whenever we sell inventory, we generate an expense called cost of sales. All right, so cost of sales is an expense account. So that one you might want to make a special note against that one. Second list, we have inventory. So inventory itself is a shorter term asset. It's an item of value to us that we hold to resell and resell in the shorter term. So we classify as a current asset. We then have heat and light expense. So again, the word expense, it's in there. So expense account. Depreciation expense for the motor vehicle. So again, it's giving itself away, classify as an expense account. Then we have our motor vehicle running expenses. So again, the name's in there. Expense account. Depreciation expense for equipment. You got it. It's an expense account. Accounting and auditing expense. Again, expense account. So a lot of these are always going to be really straightforward because the name's in it. It's giving itself away. Bad and doubtful debts expense. Expense. Accounts payable. So again, we've got that word payable in there. Pay, owe. We owe someone money. Current liability, and it's that shorter term type of liability that we've got because we'll settle it within 12 months. And then we have motor vehicles. So motor vehicles being a non-current asset. Because again, with a car, you're going to hold it for multiple years and use it to generate wealth for multiple years, not just say a single year. All right, so everything is classified now. So the next step is to go ahead and put all these items into our balance income statements. Sorry, I'm calling it a balance sheet. Ignore that. We're on income statements. So all the names are already in there. So we're just going to go through and put the amounts in. And also notice that all the items that are sitting in there are only your income and your expense account. So you will see here there is no assets, no liabilities, no owner's equity at all appearing in this income statement. Okay. So starting off with our sales, we had 280,000. So we're just copying figures across into the statement now. Still something you need to pay a lot of attention to just to make sure we get it we get it right. We then want to subtract our cost of sales because we're working with a retail firm. So there's like an extra little profit step in here. So sales less cost of sales equals gross profit of $120,000. Then we go on and subtract off our remaining operating expenses. So we've grouped them. So we start off with selling and distribution. So under selling and distribution, we list those expenses that relate to the selling and distribution function. So that's going to be depreciation for the motor vehicle, $4,500. It's our motor vehicle running expenses for $1,700. And we subtotal $6,200. Our next category of expenses is administration and general. So we list the expenses here that relate to our administration and our general functions of the business. So they include things like salary and wages of $37,000. Includes insurance of $2,000. We have heat and light, $3,700. Depreciation for the equipment, that would be, say, for office equipment, $3,200. And then we have the auditing and accounting expense of $3,400. So we add those together, we come to a total of $49,300. And then lastly, we have our finance expenses, our finance category. So here we list those expenses that relate to the finance function. So loan interest, $4,000. And then we have bad and doubtful debts of $800. We subtotal $4,800. So our total expenses comes to $60,300. And we get that by taking the total of selling and distribution, we add that to administration and general, and we add that to our finance. From there, we take our gross profit figure, that $120,000 that's all the way back up the top, and we subtract off our total expenses, and that will give us net profit of $59,700. And that is how we construct an income statement. Congratulations, you've just done your first income statement. Now we can have a look at, well, how do we interpret this income statement? So at this point, we should be able to perform a fairly quick analysis by looking at things like sales levels. Are sales levels increasing or decreasing? And by how much are they increasing or decreasing compared to the past, or say compared with our budget? We can also look at the nature and the amount of our expenses. Again, compare it with the past, compare it with our budget. And we can consider the efficiency of our business operations. Are we spending too much money? Are we spending money on things we don't really need to spend money on? All right, so all of those things we can have a quick look at with our income statement. We can also look at gross profit levels, compare it to the past. Has it gone up? Has it gone down? We can compare it with similar businesses if we can get that information. Also, net profit levels compared with the past and compared with sales. So a lot of these comparisons that we're looking at here, they are commonly performed by firms in practice. So there's a lot of benchmarking that goes on as well. So you need to be able to distinguish between profit and cash. Profit and cash, they are not the same thing at all. They're very, very different. Okay, so cash is your liquidity, okay, and it is purely about, say, cash in, cash out, if we're just focusing on cash, whereas profit comprises a whole range, it pretty much includes all, based on accrual accounting, includes all of your transactions as well. So profit can also include some non-cash items. All right, so profit doesn't necessarily generate you cash either. A business can look fantastic with their profits, but they could have no cash. Okay, so in some regards, they're two different performance measures as well. So if you recall to earlier in the video series, we distinguished between accrual accounting and cash accounting. Profit is revenue earned less expenses incurred in earning that revenue, regardless of whether or not we've received the cash. Profit also takes into account expenses that don't involve cash flow. So as I said, includes non-cash items, and depreciation is one of those non-cash items. So throughout this topic, you've learned how to determine items of revenue and expense. You know how to treat depreciation in the accounts, how to calculate it. You know how to prepare an income statement from data you've been provided with, okay, and also recognize the different formats for different situations. So as a service firm, Is it a retail firm? And also, you can do some basic interpretations of an income statement now. So that's the end of topic 4. So the next video now just provides you with an additional worked example to help you with calculating depreciation.